Diving in. Nareen, let's start off with you. We've spoken time and again, especially at around milestone events in the year, trying to predict or really sort of encapsulate perhaps the way the trend is moving. Once again, we're beginning a new year with uncertainty in the backdrop. We're around the corner from the budget. And at the same time, there's a lot of conviction in the India story. From where you're standing, what is the view looking like?
I think one is that markets are, 2022 was most interesting. I don't think if someone had told us a year back there'll be 2 lakh crores of selling by FIs and markets will hold steady, I don't think I would have believed it. But that happened due to the power of domestic investing. So I think that showed that the domestic investor has become a force and is able to withstand such big selling from FIs. And see, we are not in 2017. In 2017, we used to fear what are the credit event coming, what are the problems in the banking system, NPLs, etc. All those problems are not there at this point of time. Now we are looking only at positive events. So the only debate that keeps happening every day, morning, afternoon, evening, is valuations, valuations, and valuations. How much to worry about high valuations relative to the world, because India is costly, the rest of the world is not costly, the rest of the world has more problems, India has fewer problems, and that's a debate which never ends. And every day we wake up thinking about it, and we don't seem to have the answers actually. So what solution we have is we keep saying SIPs, because that's the only way in which we can try to reduce the risk. We keep saying asset allocation, because that's the second way to reduce the risk. The third way is to talk of debt. And these are the 3 ways in which we can find a way to reduce the risk of higher valuations at this point of time. But everything we are doing with a positive attitude, not with a negative attitude which we used to have in 2017-18. And I think 2022 was handled brilliantly, and it was actually because of the way 2020 was handled that 2022 was handled brilliantly. So in 2020, most of the other central bankers and government actually overprinted money and did too much of fiscal without looking at what are the long-term implications. So the final impact was in 2022, you had higher fiscal deficit, higher inflation in US than in India, which I have never seen in my life. So that's why we are in much better shape. But the reality is valuations are higher, and what is the negative that we are going to see due to that? Frankly, we also don't know. So that is why the only solution is SIP, asset allocation, and debt mutual fund investing, and that's what we are trying to do as an industry. Because we don't know the problems of higher valuation, how it will hit, and what problems we will suffer due to that. We ourselves don't know. But otherwise, things are good. The general mood is optimistic. The general mood is very, very good, even in the mutual fund industry, because of the way the SIP movement has happened, and the kind of products that we have at this point of time.
Prashant, let me bring you in here. And everyone always has looked to you as a consistent, for someone who delivers consistent returns through the funds that he's, of course, driving. How is the scenario different as we enter 2023? Do you see considerable challenges, or are you also extremely optimistic about the India story sustaining?
I think the growth outlook for India's economy is probably one of the best that I have seen. And I think there are 2 clear takeaways post-COVID. One, the outsourcing of services will become very broad-based, because as remote working has become acceptable, and as the Western world is aging and India continues to add to a young workforce, I think it will throw up a lot more opportunities to create white-collar jobs through offshoring in a very diverse range of areas. And I think that is good for medium to long-term economic growth. The second, I think India is clearly now competitive in manufacturing wages across Asia. So 10 years back, we were 2x of Vietnam. Today we are at par with Vietnam. 10 years back, we were 30% higher than China. Today, we are we were 30% lower than China. Today, we are half of China's wages. Apart from that, I think China plus one and geopolitical need to de-risk beyond China, I think will bring in greater investments into India by way of FDI. So I think the medium to long-term economic growth outlook of India is, to my mind, extremely positive. Coming to markets, I think two things I would like to say. The most sectors, the profitability has returned completely to normal. So I think we are here for profit growth in line with nominal GDP growth. And finally, coming to valuations, I think most sectors are trading around 15-year or higher than 15-year averages. And that is where, except the utilities sector, which is still below longer term averages. So I would say this is a market where one's expectations should be moderated to around nominal GDP growth rate kind of returns over 3-5 year periods. I think the key decider for the current year, I'm not a believer of forecasting markets, but still, I think Indian bank deposit rates have gone up sharply, and that could moderate the pace of flows towards equities. Most of the investors are positioned in the growth stocks, and I think that will probably disappoint. And last 1 year, 18-month returns have also been quite lackluster. So all of this might lead to moderation in domestic flows. If around this time we get second round of foreigner selling, first round we absorbed extremely well because local flows were extremely healthy. But now valuations are higher and flows could moderate. That could lead to some correction. So I would say I am optimistic on the markets 3-5 years, but ideally one should invest slightly lower or maybe phase out investments as Naren hinted to through SIPs. And so, but there is clearly a need to moderate expectations, and I think the pockets of excesses that have seen meaningful correction, it's my personal opinion that there is still more pain to come in those pockets. And what excesses have been created over 5-10 years, I don't think they will go away in such a early. So, and one last thing, I think China is opening up. While it is structurally probably out of favor because of the challenges there, but it's a large market, and rest of Asian markets, EMs are offering deeper value. So tactically, if some money moves out of India into those markets, it could lead to some correction. And finally, as we go maybe 6 months ahead, as markets start focusing on fiscal 25, calendar 24, I think the risk reward will steadily turn more favorable. So I don't think this is a market where one should be bearish, but because slight correction you will see value emerging, and as time goes by, I think one should start turning more optimistic.
All right, lots of interesting points coming in there, and clearly some amount of caution as we've heard so far from both Naren and Prashant, at least in the early part of the year. Rajiv, let me come to you. And I know we're going to talk more about it later, but everyone's right now looking to what's happening in the West, and with the tech winter and the kind of sell-off we're seeing on Wall Street. So talking about valuations, the topple down effect is happening already. How much of that is going to hit us back home here in India?
So if we look at the Western world, we have seen positive rates coming in after a long time. So just about 12 months back, you had trillions of dollars worth of sovereign bonds trading at negative yields, which was never heard of in the past. Now, we are at a scenario where rates are probably 4%, 5% kind of thing in developed worlds for the short-term bonds. So, really, money which had no business to be in equities is now going back to fixed income securities. Also, so much of easy money really led to this frothy environment where you had especially in the private space, where businesses with no prospects of earnings got funded, and people were really spinning stories around that. So the sell-off has been brutal. I think the traditional companies which have genuine business models and which are throwing out free cash flow, they'll bounce back and probably go back to their all-time highs. But the companies with very shaky fundamentals will probably have to go into liquidation because additional funding rounds will not come in. So we are seeing a scenario where new funding rounds are happening at lower valuations than the previous funding rounds. We have seen in the public market space also, where after listing we have seen sell-offs both in the Western world and in India as well. So it will be difficult times for those kind of companies.
Okay. You spoke about it, I mean, on the panel earlier, we had some comments coming in about how we'd seen a large cleanup, when it came to the banking space. And we have seen that. Things are better than before. But is there any risk when we enter a potentially recessionary scenario of once again seeing any kind of, fallback when it comes to companies that have difficulties with their debt or with, with just kind of surviving in these difficult times? Naren?
No, I don't think, not in the near term, because if at all the companies which could be financially in trouble, it could be some of the startups. And those startups are not debt funded, they are VC funded. So it is the VC's responsibility to find a way to fund them more, or what are they going to do, they have to decide. Some of them will go belly up, but the loss will be for the VCs. And I don't think they're all debt funded. So I don't think the problem is for the Indian financial system, and most of those VCs have made multiples of $1 billion in some of the other startups, and some of them have sold it to mutual funds also at good profits in some of their other investments. So they are also not at risk. So I don't think there is any challenge at this point of time. But 1 year back, luckily I would say that the first few new age companies which got listed caused losses to the investors. Otherwise, we would have headed for disaster, because what people were trying to do is sell companies with no income, no profits, no sign of profits to Indian investors at absurd prices. And luckily, the first few investments led to big losses, so they have to now show profits to people like us to get investments. Otherwise, we would have been in big disaster. Luckily, now we are going to tell the companies, boss, please show profits, please show some path to profitability, path to cash flows, otherwise we will not be in a position to invest. Luckily, I would say. Why? Because if 50 companies had got listed and then all the 50 had fallen, it could have been a nightmare, because most of the time people are asking people like me and Prashant, you people don't know how to look at these companies, you have looked at companies, only conventional companies. You have not looked at these new age companies, but luckily their first few failed, I would say. So I think the risk is not to the financial system, and the people who will lose money in it, they can afford to lose money. Because as you would have seen, each month there is one company which says, I have falsified accounts. But the losses are not to the Indian financial system.
Okay. What about, I was speaking to the CFO at Adani Enterprises because of the upcoming FPO, and he had a complaint. He said that, Mr. Singh said that enough mutual funds haven't picked up, our issues and haven't really participated. How would you respond to that? We've got a 20,000 crore FPO coming up there, one of the largest groups, incredibly leveraged, although very confident of their debt ratio currently. Prashant? Yeah.
So I have no money to manage right now. No, I think some of those businesses are good, and the management quality, the operationally these are very sound businesses. Whether you look at the airports business, the ports business, the power business, these are extremely sound businesses with solid entry barriers. I think the issue is basically around the valuations, and when you look at the current valuations, unless you think too much into the future, I think it is, at least to my mind, I think the valuations are on the higher side.
All right, fair enough. Sandeep, let me come to you. Clearly profitability is the buzzword, and given the current environment, higher inflation, cost pressures, so on and so forth, we're entering earnings season now, of course. And while largely companies are expected to report earnings on track, do you feel that there may be pressures going forward, even on some of the most well-performing giants as of now?
I think overall, as Prashant and Naren mentioned, overall the outlook on India remains positive. I think what happens in 1 quarter or 2 quarters does not matter. But again, I think the most important thing from our perspective has been, because the mutual fund industry, majority of the investors have started looking things from a very long-term perspective. Rather, I think when you started, the starting 2023, I think one of the key highlights of starting this year has been a data point which a lot of us have missed out. While we see the SIPs which are there coming right now, the monthly SIP is coming to about 13,000 crores. It's actually crossed 13,000, shadowless of 14,000. If you were to look at the other way around, we are a country of 140 crore population. First time we have come to a stage we are getting 100 rupee per SIP per month from every Indian. Now, and this is happening with the population of only 3% of the population investing in mutual funds. Now, let's see it the other way around. If this 100 rupee goes to 200 rupees, we are talking of going to almost 30,000 crores. And if this 3% population goes to 6%, we are talking of going to 50,000 crores per month. And I think that's the stage where we are right now. So I think from our perspective, I think the quarterly earnings are very critical, but I think we need to monitor closely. But the good thing has been, as far as the investors are concerned, they have matured a lot. They are coming from long-term point of view, and I think, and we clearly see the short-term volatility that can come in corporate earnings will not distract the mutual fund industry from investing in good companies.
All right. So talking about the companies of choice then, I'd love to get the themes or strategies with which you're approaching investing in 2023, where you find value at a time like this, and especially for those who are always wondering, which fund to go for. Is there a particular, strategy to keep in mind, whether it be a larger portion of the heavyweights or certain sectoral themes that are perhaps safer at a time like this? I'd love to get all of you to sort of comment on that. Let me start with you, Rajiv. Okay, Naren.
So, we came to a conclusion that given that this will be a year where the Fed will stop hiking rates, almost all the asset classes become reasonably interesting. So that's why something like a multi-asset strategy, whether it's gold, silver, plus equity, plus debt, plus REIT, InvIT, everything should become more interesting, because no individual asset class also is at this point of time outside debt very, very attractive at this point of time, because equities are not cheap. And this is a year where there will be a lot of volatility, because a year where Fed is going to finally stop hiking. They're going to stop hiking because either the economy slows down or because inflation comes down substantially. And when inflation comes down, it's normally due to economy slowing down. And so that's why we felt that's the kind of situation. So we believe this is a year where it's difficult to make money outside debt, but you invest in other asset classes also through the multi-asset route, so that you make money subsequently in the other years with the other asset classes. That's how we've been thinking about it. Clearly, we are more in favor of large caps or flexi caps, primarily because in small and mid caps, we have not seen any redemptions for years at this point of time, and therefore many of the stocks in small and mid caps trade at 50, 60, 70 PE. Whereas thanks to the 2 lakh crores of redemptions which happened in FIS, most of the large caps actually corrected in the year 2022, whereas many of the small caps and mid caps, some of them have just not corrected, and they continue to trade at 50, 60, 70 PE. There are a lot of cheap small and mid caps, but they are not held by the funds. It's only the costlier stocks which are by and large held by the funds, and where there has been hardly any redemptions. So that's why we are much more in favor of large caps and flexi caps. So that's how we look at it.
Okay. Prashant?
See, while we, of course, will debate and should debate 1 year outlook, but I think we should not lose sight of the nature of this asset class. And it pays to think long term and to hold equities for long periods. I mean, 100 Sensex has come to 58,000. And so, see, we are always focused on 1 year plus 10%, minus 10%. But I think India offers you a significant compounding story. So we should not lose sight of that. And valuations are not so expensive in India, while they are slightly expensive, that it will not create meaningful wealth over medium to long periods. I think coming to where could one invest, I feel the profit growth is clearly normalizing. See, at bottom, India's profit growth profits to GDP had fallen to almost 1% for 3 years back to back. We have recovered very fast to 4 to 5% range. So I think profit growth is very broad-based, unlike 3 years back, and it is normalized. I think in this kind of an environment where profits are broad-based, the high P's where growth is not supportive of those multiples, I think those excesses will go. And so I would avoid stocks where multiples are very high, even though they have corrected 20, 30, 40%. I would also focus more on large caps, because in the small mid-cap space, while Naren said there are few stocks or many stocks which are not owned by mutual funds are cheap, but I don't think they would be any meaningful part of the market. So I think it would make greater sense to invest in small companies in deeper market corrections. I think the only space where I am also sectorally slightly cautious is the consumer space. That sector has benefited immensely from lack of profit growth elsewhere. It has benefited from corporate tax rate cuts, from GST cuts. It has also benefited from lower commodity prices. But now I think all these tailwinds are missing, and the multiples continue to remain quite high for a reasonably mature sector. So I would be slightly cautious there. I think banking appears to be in a sweet spot. The credit growth is good, NPAs are extremely low, provisioning costs are low, and valuations are in line with longer term averages. So that is one space I think I would continue to be positive on.
That's super interesting. And everyone has been, of course, talking about banking being the predominant theme going forward. I also like what you talked about when it comes to consumer, because I've been trying to question where this robust demand is going to come from when we're heading in for a inflationary environment. What's your take, Rajiv?
So, Prashant and Naren have covered a lot of aspects, and largely the view is similar in those spaces. I think when we talk about index levels or valuation levels, if we say 18,000 Nifty and down the road we see 1,000 EPS, that average hides a lot of things. So to build on what Prashant ji said, I have seen consumption-oriented names in 2003 trading at early teen multiples, those going to triple-digit multiples these days. That is one segment. The other segment is the loss-making or the new age companies. So those are things which, even with a 20%, 30% fall, don't become attractive by any stretch of imagination. One segment which I think is largely ignored, so banking, of course, we also have more or less the same view. One segment which has been largely ignored and which has been underperforming for maybe 2 decades now has been the PSU space. And I think this time round the privatization intent seems to be real. For a long time, Air India privatization was spoken about. That has actually happened. There is a clear path that, barring a few strategic sectors, they will try and exit all the other holdings. If they actually deliver on that, that is a space where the asset valuations are very attractive. In some cases, they are monopoly businesses or oligopolistic kind of businesses. And with some management change, you could see significant appreciation in stock prices. We have seen turnarounds in a handful of companies. So you had the Balcos and Hindustan Zincs and those kind of companies being privatized in almost 2 decades back. I think we are headed towards a similar thing. So that is one space I would watch for.
I know you said not to talk in averages, but everyone's spoken about how high valuations are affecting things across the board. Sandeep, what is a fair valuation, let's say, for the index? I mean, if we're talking about a tapering the kind of multiple that you're looking at that you feel would be fair. And when it comes to the new age companies, I mean, I just want to take the example of, let's say, a Nykaa, for instance. I mean, we're starting to see it trade at lower levels to what it's seen after the initial euphoria post-listing. And Samir earlier today was talking about it, how it would still not be on his shopping list, even at lower prices. Would it be on yours?
No, I think Nareen mentioned, I think a lot of asset management companies, the traditional ones, have been blamed that I think we don't understand this sector. I think from our perspective, it's not a question of understanding, it's a question of valuations. And difficult to talk about an individual stock, but I think still we believe, I think we don't understand this sector, so we'll prefer staying away. I think number two, a lot of discussion for the last 20 minutes happened about equity, and I felt debt was a little underrepresented. So when you're talking about the theme for next year, fixed income seems to be attractive. I think we clearly see two things which have happened in the last 3-4 years. And many times it's not about the question that you asked, what we feel is right, but it's a question of how the investor will react to it. So last 2-3 years, investors have pulled out of fixed income and have made a lot of money in equity, especially in small cap. And the returns have been in excess of 20% for last 5 years. So I think from our point of view, the way we see, it's important for investors to understand that the past will not be repeated. And so the next few years, we believe fixed income is going to be very attractive, and small cap may or may not be able to give the kind of return that it has given for the last few years. We also believe as a fund house, for us at this point of time, mid cap and large cap is the theme for the next 3 to 4 years.
Okay, so that's pretty clear. I think large caps and of course value plays, banking, some of the key themes to really come out of this conversation so far. We are around the corner from budget, so I have to ask you if you think it's going to really have... He's already shaking his head. But any expectations, even if it's sectorally, sentiment-wise? It's also, of course, the year before major elections. So do you see markets being fairly robust, immune? Is it really only the global factors we're watching out for? Or are you eyeing some of these other factors as well? Nareen?
As I mentioned initially, we used to 90s where budget had a lot of scope to reduce taxes, customs duty, excise duty, income tax. Government has no such scope. I don't think there is the excise duty, GST Act has been passed. Everything will happen in the GST Council. So unnecessarily, everyone wants the budget to be such an equally big event. It can't be. There'll be only few things that can change in the budget. So I don't think it is possible for us to have some extremely path-breaking changes in the budget at this point of time. So that's what we have to realize. It is not possible. Government hands are also tied. You are sitting at 6.2% fiscal deficit. Where is the scope to increase fiscal deficit and give a lot of handouts to people at this point of time? You have to keep fiscal deficit under control. So I think, unfortunately, the government does not have that kind of leeway at this point of time, even in 1.5 years before the election. So I think we should reduce our expectation and realize that there isn't much that the budget can change drastically at this point of time. What the government has brilliantly done, which you have to recognize, is they have improved the computerization of the income tax department, computerization of GST, and that has resulted in huge collection of taxes over the last few years. And you would have seen the tax buoyancy at the direct tax level at this point of time, or even the tax buoyancy at the GST level, without increasing in rates in the GST side particularly. And I think that is primarily because of superb computerization that has happened and the kind of tax returns that have started on the computerization side. So I think that is what has resulted in superb revenue increase, and that's where the government needs to be complimented on. But there isn't much that the budget can do. And that's why our expectations from the budget are minimal. And that's how it has to be. If nothing comes negative in the budget, we are happy. Nothing positive we are anyway expecting from the budget.
Okay, expecting neutrality. Prashant?
No, to be honest, I mean, I would 100% agree with what Naren said. I honestly don't have much to add to that.
So budget has become more of a non-event, one would say, in the last couple of years. From a market standpoint, no major expectations this time around. Rajiv?
I am fearful of a thing for which trial balloons have been floated. There is talk about uniform capital gains tax across asset classes. If that were to happen, I would think equity holding period would go to 3 years with other asset classes, which may sentimentally in the short run be a negative, doesn't affect longer term prospects. And tax rates could go to 20% with indexation instead of 10%. So if that doesn't come, that will be a relief. Otherwise, that is a possibility given all the media stories that we are reading.
And given that equity markets have been on such a roll the last couple of years.
No, I think I agree with Naren and Prashant. Over the years, budget has become a non-event. The announcements keep coming out throughout the year, so it's no more on that one particular day. But I would, as per the capital gain things which keeps coming up again and again, I think I have a little different view. I feel I think it's just about having a clarity. This sword should not be hanging whether it's going to be increased from 1 year to 2 years to 3 years. But even if it is increased, whether from 1 to 2 or 3 and it's stable for many years, I think it will not make any impact. It's a very, very short-term sentimental thing because any investor who's investing, I think from a long-term point of view, I think is anyway investing from a long-term. And anyone who's trading is anyway paying short-term tax. So it does not matter.
So if we were to look back, let's say for the last 1 year, and if I had to just put you on the spot, what would you say is the one bet or the one thing that you got right in the year that's gone by, and the one thing that you wish you caught in the year that's gone by?
Not say 1 year. I think a few years back, whether it was PSU, whether it was value investing, it was, let's say, quality at any price investing, which we didn't believe in. And people used to say, it'll never come back. You're not a believer at quality at any price investing. Buy 80 PE stocks, buy 100 PE stocks. Don't look at price, just buy the best stocks in the country. And people used to ask us, you are obsolete because you don't buy these stocks. But now if you look in January 2023, that strategy of buying quality at any price has been completely destroyed. Now all the people who did that, people are asking themselves, what did they do? And now I don't know what they are going to do, actually. Because they're still sitting on extremely overvalued stocks. The companies are good. Companies were always good. They're sitting on extremely overvalued stocks. So I think essentially that is what, and people used to ask us, why do you buy PSUs? So even Rajiv today talked about PSUs as a theme, and it was rare to find people who felt that PSU could be an investing universe. So I think those were the thrills for us in the last 2 to 3 years at this point of time. So I would say it was more, and the thrill of seeing that mutual funds, that SIP fought FIIs and won, was something I think the entire mutual fund sales community needs to be complimented. Because I would have never imagined SIP can beat FII. And I think that the sales community needs to be complimented.
I completely agree. That was definitely phenomenal when we saw those numbers come in. Prashant, what about you?
I think my portfolio positioning last few years was quite similar to what Naren mentioned, and I think it has played out quite well, and I would specifically like to highlight 2 things, maybe 1 or 2. One, ESG as a theme had gained a lot of ground. It was never based on rational logic or fundamentals, but you can see how the majority opinion can go in the wrong direction. And I think the way ESG has been discredited or it has underperformed, I think once again highlights that in the long term markets are quite rational, but they may of course test your patience, endurance in the short to medium term. And I think I must also highlight, the defense stocks, of course they are PSUs, they were extremely, extremely cheap, they are up 4x. So I have seen time and again that focus on reasonable quality and what you are paying is extremely important, and all long-term investors should never lose sight of what you are paying and what you are getting. And if you keep that in mind, I think outcome is good. But in this market, to be honest, I don't see any futuristic themes that are deeply undervalued. I think these are reasonable markets, and these are more compounding markets and than otherwise. Yes.
Wise advice coming in there from Prashant.
Yeah, so last 2-3 years, there's no specific learning, but there are areas where one gets a lot of pushback from investors, and for which I don't have a very clear answer or I don't have a solution. So people either accuse us of selling too early or selling too late or holding on too late. So they expect us to identify the precise peak when stock prices are going to correct. So they accuse us of selling our consumption-oriented names or FMCG names too early, and they accuse us of holding on to big tech names which have done well over the last 7-8 years that we have been holding. But they said, couldn't you have sold it 6 months back or 12 months back? So that is part and parcel of the investing journey, I guess.
Well, thank you for being so honest, Rajiv. Like, totally feel your pain there.
I think from our perspective, the key, if what went right, I should say, I think we didn't get carried away with a lot of these new IPOs which came, because I think there's always a pressure. Many times, just continuing with what Rajiv said, it's difficult to justify to people why you did not invest, because they call you old-fashioned. And it was difficult that time when it was going, and especially when the stocks were above the IPO price, it was even more difficult, to justify. But having said that, I think we also believe that I think ultimately quality and valuation both have to be good. They have to be there. I think you cannot be paying excess valuation even if the business is good. And the other thing good that I think if I was to look back at the last 4-5 years that we've been able to do, not related to just investing in a stock but investing in a business line, has been to invest in the ETF business. I think the fact is today more investors are coming into ETF in the last 1 year than active mutual funds. That's again a theme which we need to be watchful of. And personally we see that especially in the large cap, the ETFs will get a very high wallet share.
So, the big bull always used to say this is going to be India's decade, and he said it's only the beginning of the biggest bull market ever. So I'll just close with that. Prashant, do you feel that we are just at the beginning, while things may be normalizing, so to say, in terms of returns, but is the India story only just starting?
See, India is the 5th largest economy, so you can't say you are at the starting point. I think we have come a long way, but I do feel that the next 2 decades, the current and the next decade, the growth rate should be higher in real terms than the previous 2 to 4 decades. I think stock markets are fairly valued. So, and India has structurally moved to low inflation. Till 2000, our inflation used to be 8, 10, 12%. Last 2 decades, it's around 5, 6%. I don't think we can lose sight of that, because that has an important bearing on total returns and investor expectations. So I think unless the real growth moves up to 7, 8%, till the time nominal GDP should continue to grow around 11, 12%. I think those would be realistic expectations, but we should not ignore a 12% CAGR over a long period of time, especially if it is 5, 6%, 7% higher than inflation. So I would say these are markets for the patient, for the disciplined investor.
Fantastic, gentlemen. Thank you so much for your time today and for your frank and very real insights. A big round of applause, please. Thank you so much. All right, well, you'll have a chance to network over tea as we break for a few moments. Look forward to having you back here, in a few minutes to continue some of these fantastic conversations.